What would I do if I had to launch a trading bot in 2026, knowing everything that I know now? Well, the answer might surprise you. So I'm going to show you the moves, the mindsets, and the tech that I'd use to win the next era of bot trading and what you need to watch for if you want to stay in the game. So if I had to launch a trading bot in 2026, I wouldn't start with indicators, entry signals, or even automation itself. I would start with structure, because in the next era of trading, structure is the only thing that's going to truly survive these extremely volatile markets. And we've already seen this pattern play out once before with prompt engineering. When AI tools first became widely available, it felt like intelligence had been automated overnight. You could type a question, press an enter, and instantly receive a polished answer. So for a moment, it seemed like the hard part had disappeared. Anyone could generate essays, ideas, even business plans in seconds. But that illusion, it didn't last. Very quickly, a gap appeared between people casually typing short, vague prompts and those who understood how to guide the system. The difference between a generic response and something sharp, structured, engineered, and genuinely useful had very little to do with the actual model itself. It had everything to do with the person that was using it. So the people getting exceptional results weren't writing one-line instructions. They were giving context. They were defining constraints. They were clarifying tone. They were setting objectives. They were refining outputs. They would adjust wording, add detail, remove ambiguity, and iterate until the response matched their intent. They weren't just asking the AI to write something, they were engineering the outcome. Access is universal. Anyone can have the tool, but control, the ability to consistently produce high quality output, belong to those who understood how to structure the input. And the tool hasn't created the precision on its own. The precision came from the person designing the prompt. And bot trading is entering exactly the same phase. Exchanges offer pre-built systems. Platforms promote plug and play automation. Connecting APIs takes minutes. On the surface, it feels as though having a bot is enough, but access to automation is not the same as having an edge. A generic bot may function adequately when markets are calm, yet markets, they don't remain stable. Volatility, it expands, liquidity contracts, trends accelerate, regimes shift. And when they do, the difference between a casually assembled system and a deliberately engineered one becomes absolutely stark. Because in both AI and algorithmic trading, the advantage was never the tool itself. It was always the architecture behind it, the constraints, the risk logic, the structural design that determines how the system behaves when conditions change. So here's my first way to build a bot in 2026. Avoid generic exchange bots and grid bots. So in 2026, everyone's going to have automation. Very few are going to have that engineering that we've talked about. And that distinction immediately eliminates the first mistake I would avoid. And the first thing I would not do is rely on a generic exchange bot or pre-packaged grid systems. Not because automation is flawed, but because most of these systems, they're built for convenience and not for durability. They're designed to be easy to deploy and easy to market. And what they are not designed for is survival. And they won't be able to survive different market regimes. Grid bots assume orderly mean reversion. They distribute orders mechanically and they harvest small price movements, which work in stable range-bound conditions. But markets don't stay stable, they trend, they accelerate, liquidity disappears, volatility expands. When that happens, a static grid doesn't adjust, it increases exposure into weakness. So generic exchange bots have the same limitation. They look customizable on the surface, but underneath the logic, it's simply fixed. And when conditions shift, fixed logic becomes extremely fragile. If automation is the engine, then risk architecture is the chassis. Without a strong chassis, more speed just means a faster breakdown. And that's why the first step in launching a serious trading bot in 2026 isn't choosing which bot to activate. It's making sure the system you use is built to survive when markets stop behaving nicely. Now, here's the second thing to build a bot in 2026. Build or use a feature-rich adaptive algorithm. So if the first step is avoiding structural fragility, the second is building structural adaptability. In 2026, I wouldn't rely on a single logic system, not one indicator, not one condition, not one fixed response to price. Markets don't operate on one dimension, and a bot that does will eventually break when the dimensions change. Instead, I would use an adaptive algorithm, one designed to respond to different volatility environments, liquidity conditions, and trend structures. That means that dynamic position sizing rather than fixed exposure is essential. It means defensive scaling instead of blind averaging is, of course, very important. And it means intelligent exits that adjust dynamically as momentum strengthens or weakens, rather than static take profit levels sitting in the market regardless of context, and also filling it up with those limit orders, which we don't want. A feature-rich system isn't about complexity for the sake of it. It's about flexibility with discipline. The algorithm should be able to contract risk when volatility expands, press advantage when conditions are favorable, and reduce exposure when uncertainty increases. It should understand the difference between chop and expansion, between a pullback and a structural breakdown. Now, most bots are built like switches. They're either on or off. An engineered algorithm behaves more like a system of gears. It shifts. because market shifts. And in 2026, speed won't be rare. Access to indicators won't be rare. Even AI-generated strategies, they won't be rare. What will be rare is a system that can adapt without abandoning its risk framework. Now, that's the difference between automation that reacts mechanically and automation that is architected to survive change. So the third decision I would make is deceptively simple. I would trade fewer assets. In a world where automation makes it easy to scan and execute across dozens, even hundreds of markets, the temptation is to diversify endlessly, more pairs, more opportunities. It feels robust, it feels sophisticated, but breadth is not the same as edge. So instead of spreading capital thin across random instruments, I would concentrate on a small number of structurally significant assets, markets with deep liquidity, institutional participation, and long-term capital inflows. Assets that sit at the center of macro cycles, not the fringe of speculative rotation. I would trade things like Bitcoin, gold, the Nasdaq, the S&P 500, not because they're guaranteed to rise in a straight line, but because they attract sustained global capital and exhibit recurring liquidity cycles. They respond to monetary policy, business cycles, and risk appetite in ways that can be studied, modeled, and respected. And when you focus on structural assets, you gain familiarity with their behavior. You begin to understand how they'll expand during optimism, compress during uncertainty, and mean revert during digestion phases. That behavioral depth becomes far more valuable than chasing every new instrument that appears on an exchange. So automation makes it possible to simply trade everything. Engineering requires you to choose carefully. By concentrating on a handful of high quality markets, you're going to align volatility capture with long-term capital inflows. You're not just harvesting random price movement, you're operating inside assets that actually matter. Assets that tend to recover because they are systemically relevant. In 2026, the edge won't come from trading more, it's going to come from trading smarter. Now, my fourth piece of advice for launching a trading bot in 2026 is to automate execution, but let the human manage the risk. So the final principle is about role clarity. If I were launching a bot in 2026, I would automate execution completely, but I would never ever outsource responsibility. There is a critical difference between delegating execution and delegating judgment. Machines, they're superior at consistency. They do not hesitate. They're going to make trades while you're asleep, while you're on the toilet. They're not going to second guess. They do not panic during volatility spikes or become euphoric during breakouts. Once logic is defined, they execute with precision every single time. And that makes them ideal for entries, for scaling, for trailing exits, and systemic reactions to price movement. But risk is not just an execution function. Risk is a capital allocation decision. The human sets exposure limits. The human decides how much capital it is deployed. The human determines acceptable drawdown. The human decides when macro conditions warrant reducing overall risk. The bot should handle reaction speed. The human should control survival. This division of labor is essential. When traders blur the line, they either interfere emotionally with execution, overriding the system at the worst possible moment, or they detach entirely and allow exposure to grow without supervision. In 2026, automation will be everywhere, but discipline will be not. A well-engineered system allows the machine to do what it does best, execute rules without emotion. At the same time, it keeps the human in the role. That matters most. Managing capital, defining boundaries, and ensuring that no single market regime can cause irreversible damage. Automation is a tool, but risk management, it's a responsibility, and confusing the two is where most systems fail. So when you put these pieces together, a pattern becomes clear. Avoid fragile templated systems, build adaptive architecture, concentrate on good assets that are going to increase over the long term, automate execution, but retain control of risk. None of this is flashy. None of it sounds like a shortcut, but that's precisely the point. 2026, the edge is not going to belong to whoever has the fastest bot or the most indicators laid in on a chart. It's going to belong to those who design systems that can withstand expansion, contraction, regime change without collapsing under their own exposure. The reality is, however, that building something like this from scratch requires significant engineering. It requires volatility modeling, position sizing logic, defensive scaling frameworks, and a clear understanding of how different market environments affect risk. And of course, you need to then create simulations and thousands and tens of thousands of them. And most traders don't lack access to tools, but they do lack the structured architecture. And they also lack the time and the investment required to do this. And that is exactly why we built our algorithm the way we did. It's designed around adaptive risk management, defensive scaling, and structural asset focus. It integrates directly through TradingView, and it's currently used by over 300 clients around the world who want systematic exposure without relying on guesswork or emotional execution. So if you're serious about deploying a trading bot in 2026 the right way with engineering, not just automation, you can find more details below this video in the description. Because in the next era of markets, access will become common, design will not. And you want to get involved with a team that has spent years developing a system that has been tested in live markets, and you want to use an algorithm that you can trust and that will work for the long term.